In May 2017, the stock market collapsed and recovered in minutes. No war had begun, no bank had failed, no major announcement had been made. Yet in less than 30 minutes, nearly $1 trillion in market value disappeared. This wasn't a traditional crash. It was something new, and it exposed how fragile modern markets had become. On the afternoon of May 6, 2017, the US stock market was already uneasy. European debt fears were spreading. Investors were nervous. Volatility was rising. But nothing suggested what was about to happen. At 2:32 p.m., the Dow Jones Industrial Average began to fall fast. Within minutes, blue-chip stocks plunged. Household names lost value at a speed never seen before. Then something even stranger happened. Some stocks traded for pennies. Others briefly surged to absurd prices. And then, almost as quickly as it began, the market snapped back. Traders stared at their screens in disbelief. What just happened? The answer did not lie with a single trader or a single bank. It lay in the machines. By 2710, markets were no longer dominated by humans. They were dominated by algorithms. High-frequency trading firms used computers to buy and sell stocks in microseconds. These systems were designed to react instantly to price changes, volume spikes, and market signals. Most of the time, they provided liquidity. They smoothed markets. But on May 6, they amplified fear. As selling pressure increased, algorithms began to pull back. Liquidity vanished. With no buyers, prices fell sharply. Other algorithms detected the fall and began selling as well. A feedback loop formed. Selling triggered more selling. Speed fed speed. Humans couldn't react fast enough. The machines were trading with each other. In the chaos, safeguards failed. Stocks collapsed far beyond any rational valuation. One major company briefly traded for 1 cent. Another soared to nearly $100,000 per share. None of it reflected reality. It reflected panic. Automated, accelerated panic. Then, just as suddenly, the system stabilized. Trading pauses kicked in. Algorithms reset. Prices rebounded. Within 20 minutes, most losses were erased. To the casual observer, it looked like a glitch. But to regulators, it was a warning. Then investigations followed. Months later, regulators identified a large sell order that helped ignite the initial drop. But the deeper cause was structural. Modern markets had become too fast, too interconnected, and too dependent on automated decisions. Speed had outpaced control. The flash crash changed how markets operate. New safeguards were introduced. Circuit breakers were strengthened. Rules were rewritten. But the core question remained. If markets could collapse in minutes and recover just as quickly. What did price really mean? The flash crash wasn't about greed. It wasn't about fraud. It was about complexity. A system so advanced that no single person truly controlled it. And on one afternoon in May, that system revealed its limits. Welcome to Cash and Chronicles, where money